Well, next on the India development debate, we're talking about your investments and a very interesting trend that is being seen. You've probably heard about the Robin Hood investors. Some call them hobby traders. But one part of the story is also the kind of returns or perception of returns that we've been seeing from mutual funds. So now a couple of things to mull over. Over a 3-year period, mutual fund returns have not excited several investors. In fact, only 6 out of 192 equity mutual funds have given double-digit 5-year SIP returns. On the other hand, you've also seen equity mutual fund inflows and MF inflows overall plunging in the month of June. So what's going on? Are mutual fund investors, your retail investors who were convinced that mutual fund sahi hai, having second thoughts? Are the relatively low returns cheesing off or putting off investors, and are they now turning to investing directly? Is that a good idea? How will that really work out? To speak more on this, I'm joined today by Dhirendra Kumar. Great to have him on the show today, CEO of Value Research, and Nikhil Kamath, co-founder and CIO of ZERODHA. Welcome to both of you, and good to talk to you today. Dhirendra Kumar, let me start with just getting your view on what is going on. So a lot of this is perception game, but there are hordes of small investors whose first major brush with investment has been via the mutual fund, and it's not been very great in the last 3 to 5 years. Would you agree on that?
Yes, a lot of investors have come in, are beginning to invest in mutual fund. It's a recent phenomenon. Mutual fund, it's still in its state of infancy. But what you're saying, that it is still a game of perception, there is no perception here. The returns are real, and the inflows are real, and they get reported every year. If this month mutual funds have still got 8,900 crore as compared to 9,200 crore last month, this is not perception. This is people writing check and money getting debited from their account. The 3-year return from Sensex is 5%, and 3-year annualized return, trailing return of mutual fund, of the large cap fund, is 3.92%. So, this is also real. People, the money which is lying there, you can well take it, if you want to. The whole perception bit is entirely, yes, it is disappointing. Investors expected far higher return, and more so, the kind of funds where investors have put in their money, particularly the small cap and the mid caps, because it's very normal. Mutual fund investors chase recent past performance, what has done well, and that is true for any investment. Many investors try to ride the momentum, and it is good till it lasts, and in between they get some major blow-ups. And that is what is true, but in fact, going by the way the market has recovered, it is quite surprising that despite all the gloom and doom that we are looking in the real economy, because of the dynamics of the market, because of absence of alternative, you have to see that compared to what? Look at the deposit rates, the way they have crumbled. Look at the fixed deposits, or all the fixed income avenues. Indian investors are dominantly fixed income investors. The way it has collapsed, people will have to see. Also, the way mutual funds are sold in the last 2-3 years, people are being told time and again that come for the long term, do your SIP, don't try and gamble, don't try and dabble it and don't try to time it. Maybe it might take longer. Investing in equity is a general bet on economy. If you are upbeat that next 3 years, 5 years, 10 years, sometime we get out of this crisis, we gain our momentum.
Yeah.
So it is a bet on that.
No.
But if it can't be really.
No,
I can't look at it in isolation.
No, I want to. No, I agree. I want to understand what really has been going on, though, Dhirendra. You talked about 4 and 5% returns and talked about comparing it to other options. Your fixed deposit, etc., etc. 4 and 5% is abysmal. What do you think is the reason behind this? Is it simply, that's the mechanism of how it works? Because people are now beginning to ask questions about the kind of upfront sort of payment and fees that you pay when you invest in a mutual fund? What really have fund managers been doing? Have they taken the right bets? Is there enough accountability of these kind of returns? Do you think that these are important questions to dwell on right now?
Question. Investors, finally they invest for returns, and one has to see that, but I would say that, we have moved the frontiers on, even on expense, on disclosure, on transparency. Every investor knows what he's getting into. But I think the real thing is that, last 2-3 years, it has been extremely disappointing. The real economy is in the dumps. If you look at Sensex, you'll find that there has been a lot of activity in the market, whether on the stock front, SEBI chief coming and warning people that he is quite perplexed. This is the expression he used, that he's perplexed by the, quantum of, scale of individual investors' participation. So that is, it undoubtedly is. People are excited and they are not getting any meaningful return. But I think it's a function of time. One has to really elongate this. Companies are struggling. In the long run, stock prices will go up only if companies are able to grow their earnings and they get into that growth mode. We haven't seen our economy in that mode in the last 5-6 years. We are only in the cleaning act. The real economy is in the cleaning act. Banks are struggling. 90% of our banking industry has been struggling. Who knows? This could well be the turning point if we get out of this.
Fair enough.
Yes, but this has been a crisis. It is disappointing, and you don't have alternatives.
Yes. Yeah, but you know what? People see the kind of disconnect the stock markets have with all of these woes in the economy that Dhirendra is talking about, and they're like, well, it's working there. Nikhil Kamath, are you seeing that kind of change in perception taking place, and is it advantage investors who want to now come in directly, cut out the middleman, so to speak?
Hi, Tamanna. I think as long as the investors are coming into the market, be it from a mutual fund or a direct equity investment, for a country which has a population which has such under-penetrated access to the equity markets, I think it's good if they come in through a mutual fund. It's also good if they come in directly. I don't think one industry necessarily competes with the other. The goal is to together grow the pie and have increased participation amongst the retail investors of India.
Okay, no, agreed. That's a fantastic message, Nikhil, as long as the money is coming to equity markets. But we're talking about, and you're talking to investors over here who are wondering whether it makes sense to remain in mutual funds or come in directly. Most investors, unfortunately, are not thinking, oh, at least I'm contributing to the equity markets and deepening them one way or the other. They're focused on returns, like Dhirendra said a short while ago. What makes sense for them? Do you think that retail investors are getting cheesed off with mutual funds?
Tamanna, the thing is, over the last decade or two, the asset management industry as a whole, I would say not just in India, but across the world, the models haven't really changed. You have statutory fees that you pay immaterial of how well or how badly a fund manager does. We do have distributors and too many middlemen selling products. A lot has to change to make this industry more efficient. The incumbent fund houses in India have been a little averse to, starting great ETF products or pushing ETF products in India, because it kind of takes away the earning and their revenues from existing products, which might offer a bigger margin for a distributor. So plenty has to change in asset management. I would say client-aligned models are the need of the hour, wherein a fund manager or a fund house kind of benefits depending on how well they perform, and they don't have a common fee which they charge on years when they do well and when they don't do well as well. So a lot has to change. I don't think in terms of the money being allocated to the equity markets, the route a retail investor might take has changed structurally. A lot of the numbers from June, when the mutual fund inflows have gone down, have many short-term discrepancies at play. I think this trend will reverse in the future, and mutual fund inflows will start again, and direct investment into equity will continue to grow as well. But I think the onus is on the asset management industry in India to make a product which is more efficient and more suitable to today than the incumbent products and fund managers we have in the industry.
Yeah, that's an interesting point. Dhirendra, you want to come in on that about incentives for fund managers being aligned to their performance?
No, there is of course, these are little misaligned. Whether a fund manager does well or poorly, he takes a fee. Of course, it is little aligned in the sense that, if a fund manager is able to turn the NAV from 10 to 20, he makes twice as much. And if a fund manager is able to, turn investors' money 10 rupees into 8 rupees, he earns 20% less. So it is aligned. But, it is not aligned as strongly that, it is not aligned in a manner. And there are practical, at SEBI, people have been banging their head in terms of aligning it more intensely in a manner because, these are also open-end funds. Also, I would, refute one point. What Nikhil is saying is all valid. We just need to democratize many ways of, channelizing household savings into equity because equity ownership of Indians is absolutely low. And there are many vehicles which have been initiated. Some vehicles which are not visible today. For example, the Provident Fund money, incremental 5% money flows into equity. NPS, a lot of money, 10% of all the government employees' contribution, which is matched by the government, flows into equity. And that aggregates to about over 2 lakh rupees today. And it happens, and this money comes to stay. This money is not a kind of money which moves back and forth into the market. It comes and remains there. Yes, ETF could be a low-cost way. But, assuming that, 5 years back, we had a whole range of ETFs which were low-cost. We just have one low-cost ETF today because the rest of the ETFs are not even low-cost. That is available to Indian investors. And also, it's a chicken and egg story. One is that unless you have a broad supply, you will not create the market. And till you create the market, the efficiencies won't kick in. Because if you look at, the Indian ETF market, in the absence of a reasonable number of investors, it trades at a huge premium or discount. It is weird. In fact, buying ETF in India could be hazardous today, except for the Nifty one, which is which is large and it has decent scale. Except for one. So I would say that there are many ways, but at a very fundamental level, if companies don't do well and their stock prices don't go up because the earning is not going up and a market becomes very narrow. Sensex was propelled by only 4 stocks in the last year. The decent return of 5% annualized that you see over the past 3 years. That is also very narrowly led by 3-4 companies as of Sensex. So in that sense, unless you have broad...
Fair enough.
ETF, equity, direct ownership, mutual fund, nothing will help.
Yeah. No, okay. I just want to ask one question though. Then I'll get a quick response from both of you. Which is it safer? Is this a better idea? I mean, we know a lot of people, and anecdotally, there's no way to know the exact figures though, a lot of people possibly have now decided that let's take a go at this ourselves. Mutual funds were always supposed to be the vehicle for those who didn't have the know-how or the time to track the markets very closely, and so you put your money in a mutual fund and of course good fund managers took care of it. Now a lot of people are doing it themselves. It's like a DIY phase. Nikhil Kamath, is that a little dangerous? Where investors can get burnt? There may be a greater upside, but then a bigger downside as well.
There are 2 ways to look at this, Tamanna. There is, if you go back in time and you look at the history of investment, there is a case to be made that passive investing has done better than active investing or a fund manager managing your money. And there is a case for the other side as well. In terms of retail investors coming into the market directly, the ones who are doing it by virtue of investing in large cap blue chip companies, I think they're kind of okay. And I have to, at some level, commend the regulator or SEBI they seem to have been one step ahead throughout the pandemic. And they saw that a lot of retail investors were coming in and using leverage as a product to enter. And 2 days ago, they came out with a new circular which kind of rationalizes the amount of leverage available for a retail investor to trade and transact in securities, I think, which will make the market a bit more stable. This will happen in a phased manner starting in a couple of months, but I think it'll go a long way. These tiny things that the regulator is doing, I think, will go a long way in making the markets more stable and robust in the long term.
Yeah. Dhirendra, I just want a quick take from you on this trend. And of course, the regulator here, going to ask investors to put up to 100% margin gradually for the calls they make and curb day trading in that sense. But in terms of safety, do you think it's time to stop treating retail investors like little children and assuming that they don't know what they're doing?
Well, I think, they should be treated as grown-up children. And they should be let off. And I think I think it is dangerous. But let there be danger. There is no other way investors will learn. There is a learning curve to it. People learn. People trade. They try it. A market is far more efficient today. You have ZERODHA, grow this, that. Where you can actually, without much of a friction, come on board, start trading. Leverage was a very dicey thing because it gave you were just able to. It was, it could have actually, short-circuited your route to bankruptcy. You fail faster. But, this is, I don't think one should curb speculation or one should, it is always good. This is the price that you pay for learning. Every investor starts with his 5,000, 10,000 rupees with grand dreams, which will multiply, and it does multiply, and then you lose it, and then you understand that what all is going on. It takes time, and investing is one area where you don't learn from other people's mistakes. You have to lose your own money. Earlier you learn it with small money, better it is.
Yeah, I like the part about grown-up children. Well, lessons need to be learned at any phase of your life, and that's really how you get better. Thank you so much, Dhirendra Kumar and Nikhil Kamath, for joining us on the India Development Debate this evening. When we come back, you're going to hear from the big guys of the fintech space, Vijay Shekhar Sharma and Sachin Bansal. Don't go away.